Warren Buffett is an individual with a net worth exceeding $130 billion. From a shy boy selling Coca-Cola door-to-door, he went on to create the nearly $700 billion conglomerate, Berkshire Hathaway. Known as the Oracle of Omaha, he has consistently ranked among the wealthiest people in the world. What sets him apart from other billionaires is that he did not inherit his wealth, nor did he achieve it through technological innovation or building his own business. Instead, he grew his fortune through strategic investments in the stock market. Buffett's life story attracts a loyal following, with thousands gathering each year for the Berkshire annual meeting, including fans, team members, and community members. A significant portion of Warren Buffett's wealth comes from his ownership stake in Berkshire Hathaway. However, Buffett's early career was much simpler. He was born in Omaha in 1930, right at the onset of the Great Depression. At that time, the stock market had halved in value compared to the previous year, and Nebraska was severely affected, relying heavily on agriculture. The plummeting commodity prices led to the downfall of many companies. Buffett was fortunate to be born to Howard Buffett, a local stockbroker. As a child, Warren was shy and reserved. He spent much of his early years alone, reading books in his father's library. This solitude cultivated an early obsession with investing and business. Eager to apply his knowledge, he approached his grandfather, who owned a grocery store, asking for soft drinks to sell in his neighborhood. His grandfather agreed, and at the age of 6, Warren launched his first business selling Coca-Cola, earning 5 cents for each package sold. He quickly expanded his offerings, and within a year, he was selling gum, magazines, and Coca-Cola, making a decent profit. At 11, he used his earnings to purchase his first stocks. He bought 3 shares of a gas and oil company called City Service, each valued at $8. After some time, the stock's value dipped to $27. Despite his anxiety, he held on to the shares until they rose to $40 before selling. While he made a profit, he realized that the stock eventually surged higher, a missed opportunity that haunted him but taught an important lesson. These experiences helped Warren gain wisdom beyond that of average boys his age. Years later, his father was elected to the U.S. Congress, prompting the entire Buffett family to move from Omaha to Washington, D.C. there at 14. Warren secured his first job delivering newspapers for the Washington Post. Dissatisfied with his earnings, he took a second job with a competitor, the Times Herald, delivering papers simultaneously, which boosted his earnings to $19 a month. Buffett then used his income and savings to buy pinball machines with a friend and installed them in a barbershop. Soon after, they acquired 2 more machines and split the profits with the Barber Weekly. They eventually sold their machines for $1,000, and with the proceeds, Warren purchased his first property, a 40-acre plot in Nebraska. Remarkably, Warren was only 15 years old when he acquired that farmland. Even at such a young age, it was clear the boy from Omaha was pursuing something significant. He told his friends that if he wasn't a millionaire by age 30, he would jump from the tallest building he could find. After graduating high school in 1947, Warren enrolled at the University of Pennsylvania and financed his studies through rental income from the Nebraska farm. After obtaining a bachelor's degree in business administration from the University of Nebraska, he applied to Harvard for his master's degree but was rejected. This rejection turned out to be a blessing, leading him to register at Columbia Business School, where he studied under Benjamin Graham, an economist and investor whose work profoundly influenced Buffett. Just a few years after graduating, Warren worked for Graham at his investment firm. There, he learned to identify the true value of a company through its financial statements. However, 2 years later, Graham decided to retire, closing the firm and leaving Buffett to navigate on his own. Yet Warren's hard work didn't stop. After gaining invaluable insights from Graham and saving diligently in 1955, at age 25, Warren Buffett returned to Omaha to establish his own firm, Buffett Associates Limited. Though he had enough capital to rent office space and hire employees, Buffett chose to operate from his bedroom at home. He invited several friends and family members to invest a total of $105,000, and shortly after, he launched his small investment company guided by his mentor's principles. Warren began investing in undervalued stocks, but took this philosophy to extremes by buying poorly performing and almost bankrupt companies at rock-bottom prices. If the company liquidated its assets, their value often exceeded the purchase price. He referred to this strategy as cigar butt investing, akin to picking up a discarded cigar butt and enjoying a few last puffs for free. His investments followed the same principle, buying shares at an incredibly low price and treating the purchase as free because the company contained hidden treasures worth more than what he paid. If you want detailed insights about the companies Buffett has invested in and the rationale behind those investments, let me know which companies you'd like to discuss in the comments below. And don't forget to subscribe and turn on notifications so you won't miss out. Warren Buffett's investment strategy is remarkably simple and accessible for everyone. As he once said in a clip, and you have to be able to ignore what other people are saying and simply look at the facts and decide. What matters, according to him, is understanding what I'm doing. The good thing about this is you don't need a high IQ. You need the right orientation. 90% of people who buy stocks don't think about it properly. They hope the stock will go up next week, and if it goes down, they feel bad. I feel better. I think about what the value of the company will be in 10 or 20 years. And I hope the price drops when I buy it because I'll buy more. It takes a temperament quality that is much more important than an intellectual quality. I mean, if you have an IQ above 125, you can throw away the rest of the points. You don't need it in investing, but you need a certain temperament that allows you to think for yourself and then find a framework. If you want to learn Warren Buffett's proven investment strategies that have helped him become one of the richest individuals in the world, you can watch all the Berkshire Hathaway annual meeting videos from the 1960s to the present. Then structure them into a solid framework. Or if you prefer a quicker approach, sign up for a free trial of structured learning materials. In January 1962, at 32, Warren purchased a struggling textile company in New England that had closed 11 plants. Warren acquired many shares at a low price, eagerly awaiting to finalize the deal. A few years later, they shook hands at an agreed price of $11, but the CEO of Berkshire attempted to cheat Buffett for 13 cents. In retaliation, Warren bought more Berkshire shares until he gained enough votes to dismiss the CEO. Instead of letting the company go to waste, he invested the company's funds in buying shares of other attractive companies. However, this unpleasant experience and Buffett's growing capital led him to revise his strategy. Rather than seeking nearly bankrupt companies, he shifted his focus to quality companies available at fair prices, moving away from solely looking for bargain basement firms. His initial purchases became a launchpad for his future successes. Today, Buffett continues to leverage his analytical skills to find the best stocks in the overall market. However, this is only part of why he has become one of the wealthiest individuals worldwide. Another critical factor was Buffett's entry into the insurance business. In 1967, he began acquiring insurance companies, starting with National Indemnity, followed by Central States Indemnity, culminating with Geico in 1996. Buffett grew fond of insurance businesses because, like banks, they regularly receive premiums from thousands of clients, which adds to the company's balance sheet. However, clients can only withdraw their deposits when something disastrous occurs, when their house catches fire or their car gets into an accident. In this manner, the companies effectively manage billions in cash, technically considered debt, which doesn't appear on their balance sheets. This capital can then be invested, often yielding exponential returns before any claims necessitate payouts. Afterward, Berkshire also acquired numerous companies, including American Express and National Indemnity in 1967. Under Buffett's leadership, Berkshire acquired leading companies such as Blue Chip Stamps, 1968, Illinois National Bank, 1969, and the Washington Post, 1973. Furthermore, other insurance firms like Geico were acquired in 1976, Safeco Insurance in 1978, General Foods in 1979, AON in 1984, Solomon Brothers in 1987, Coca-Cola in 1988, General Re in 1998, and BASF in 2006. Berkshire's portfolio also includes Bank of America, Kraft Heinz, Apple, Chevron, Occidental Petroleum, and many more, resulting in its current diverse holdings. If you want to learn Warren Buffett's proven investment strategies that have helped him become one of the richest individuals in the world, you can watch all the Berkshire Hathaway annual meeting videos from the 1960s to the present. Then structure them into a solid framework. Or if you prefer a quicker approach, sign up for a free trial of structured learning materials. Let me know which companies you'd like to discuss in the comments below. And don't forget to subscribe and turn on notifications so you won't miss out. See you in the next video.